So let's talk about trusts and the different types. So first of all, everybody knows the analogy of like the trust fund kid, meaning, they have money coming in from, rich parents and stuff. So what is the purpose of a trust? So it's kind of a pretty good analogy because generally the purpose of a trust is it's a three-party relationship where the goal is to avoid gift and estate taxes. Gift taxes, so when you give a gift, or estate taxes when you die, right? Usually only applies to very, very wealthy people. It's around like cutoffs around like $14 million or so. That changes a little bit every year. So it's a three-party relationship consisting of the or. I call them the or. It could be trustor, grantor, settler. That's the person funding and creating the trust. The trustee, who's a fiduciary, which means that they're obligated to act in the beneficiary's best interest, meaning they're obligated to act in the best interest holistically of the beneficiary, the person who received the money from the trust, or all the beneficiaries, because there could be multiple. And, under the Uniform Prudent Investor Act, you're supposed to act basically in everyone's interest, unless the trust says otherwise, the trust document. So now, the different types of trusts. There is, the difference between simple and complex, irrevocable and revocable. You could say revocable or revocable, doesn't really matter. It's pronunciation, either. And so simple, complex, irrevocable, revocable, and inter vivos or living or testamentary. So let's go over those one at a time. So very simply, an inter vivos or living trust is a trust established while someone's alive. So because it's established while someone's alive, it avoids probate, which means that's the legal process of settlement when someone dies. So that's very, very helpful because probate it can be a public, can be expensive, can be messy process. You have to validate the will. And that's actually why testamentary trusts are they don't avoid probate because someone has to validate, make sure the will is legitimate, right? So a testamentary trust, kind of like last will and testament, is created by a last will and testament, by a will. So that's kind of the pretty simple distinction there. Now there's like simple versus complex trust. So simple trust has three rules. So no charitable giving. All the income has to be passed on to the beneficiaries every year, so the trust can't accumulate income. And then there's the third rule is you can't touch the corpus of the trust, which means the body of the trust. What does that actually mean in actuality? The trust is composed of bonds. You can't sell the bonds, but you can't sell the bonds and take out the money, but you can, the interest has to be given every year to the beneficiary, right? So that's simple versus complex. Now, the most interesting one and most tested one is irrevocable versus revocable. Irrevocable means that you can't change your mind, right? Can't revoke it. You made it, can't change your mind, right? And by the trust being irrevocable or irrevocable, the IRS considers that it's no longer controlled by the grantor. So it's the benefit of it's not going to count as part of the grantor's estate when they die, which is very, very helpful because if you're uber wealthy, you're what, 20, $30 million rich or $100 million, that money is going to be hit with estate taxes. So the more you can separate that money from each other into trust, the more you can avoid taxation, right? That's why, for example, like an irrevocable life insurance trust that's, let's say, the proceeds of life insurance are tax-free to the beneficiary. So by eliminating that, removing it from someone's estate who's uber wealthy, that makes the process easier, and there's no taxes anymore. The other thing that changes with the trust being irrevocable is that the income is going to be taxed at the trust tax rate, which is actually not such a great thing because trusts have very compressed tax rates. It's like I believe it's like 15%. I'm sorry, if you make more than 15,000, it's taxed at 37% versus versus ordinary income. It's like you got to make like, what is it, 650K or some crazy number to get taxed at 37%. So then revocable trusts, right? They're not separated from the state. So the grantor can change their mind. So if Johnny says, F you dad, I hate you, he can, remove the trust, right? Get rid of the trust. So the benefit of revocables obviously can change your minds. Also, the income from the trust is actually taxable at the grantor's tax rate. So it's not going to be as compressed. But the problem is when they die, whatever's in the trust is considered part of the grantor's estate. So there's no saving on estate taxes. So, I guess another benefit of revocable is it avoids probate. So you do avoid the process of like validating the will and stuff like that. Kind of like TOD on a brokerage or POD on a bank account. So I hope that helps. And just to kind of reiterate one last time, three-party relationship, right? You have the trustor, grantor, settlor, the or who creates and funds the trust, trustee, fiduciary acts in the best interest of the beneficiary, right? Under the Uniform Prudent Investor Act, and the beneficiary who just gets all the money. So hope that helps, and listen for more. Thanks.